Well, we are at the JP Morgan India Investor Summit and in conversation with the man himself, Sajjid Chinoy, joins us right now. Sajjid, so good talking to you. Thanks for being with us.
Pleasure to be here.
And thanks for having us at your summit. It's been wonderful. I hear it's the India interest is palpable and the biggest that you guys have
It's the largest
seen.
Summit we've had, exactly.
Wow.
So, a lot of interest in India.
So let me start off by asking you, what has been the most asked question to you thus far? It's early hours.
Right.
Or what's been
In a strange way, it is, I guess it's the world we live in. It's about the Fed, right? That why did the Fed cut 50 and what has this been going forward for emerging markets and for India? And my answer always is, Niraj, less about whether it was 25 or 50. It was more about, is the Fed cutting from a position of strength or a position of weakness? And what do I mean by that? If we're on the cusp of a US recession, people talk about the Psalm rule that has been triggered. If it turns out that the labor market is not bending but breaking and we're slipping into recession, the Fed will keep cutting, right, by large increments. But that's a world in which there will be a risk-off and in which emerging market currencies will come under pressure. So the Fed can keep cutting, but if the US is in recession, that's not a good environment for most emerging markets. And then you're in this dilemma where on the one hand, a global recession would warrant monetary easing at home, but if your currencies are under pressure, it makes it harder to cut interest rates. And that's a world we want to avoid. If instead the Fed is cutting more slowly from here on end, it's 25 and 25 and 25, but it's not because the US economy is in recession, it's because the US economy is slowing and the Fed is buying insurance to protect growth for 2025 and ensure some kind of soft landing. That's a world in which risk assets will do very well, right? So it really is, why is the Fed cutting? And the good news is that even though the labor market has been slowing, the vast multitude of indicators suggest the US economy is holding up. In fact, the Atlanta Fed's nowcaster has US growth in the third quarter at 3%, very far from a recession. So if the economy is gradually slowing, and the Fed's own Taylor rules will suggest that if their forecasts are right, there's at least 200, 250 basis points that they can cut to bring rates down to the level that's appropriate with growth and inflation. That's a very constructive world to be in which the US economy is slowing, the underlying fundamentals have not broken, and yet the Fed is easing monetary policy to buy insurance for a soft landing in 25. Too early to say we're there, but it's that distinction, I think, that matters more than whether the Fed's going to cut 25 or 50 back in November.
So actually, that was going to be my next question. A lot of people have argued, and I think there was some dissenting Fed governors, right?
Yes.
9 out of 19 participants saying soft dissent, projecting 75, etc.
Right.
So do people need to think too much about whether it's 25 November and then going ahead? Could there be a miss? Could there be only 25 and not supersize? Will that be a problem or not really?
It won't be a bad thing if the Fed is cutting 25 from here on end, for exactly the reasons I mentioned. If they get scared about the labor market, the next labor market print is again really weak, then the Fed may well go 50, right? But you don't want that to happen. You want to be in a situation where the economy is holding up and the Fed is still moving in small increments, and it can still do that because A, it has much more confidence that inflation is trending towards 2%. And B, because, as I mentioned, it's about 200 basis points away from what their own Taylor rule would suggest rates need to be.
Right. Got it. So what does this do to central banking actions across the world? Because I heard you say that this is idiosyncratic. Brazil is raising, Japan is raising. Where does this leave the Reserve Bank of India? Dependent on what the Fed does or not really?
So let me answer this in two ways. I think one is Asia more generally. I think Asia is one region in which most economies in Asia are below their pre-pandemic path. And that's just another way of saying there's a fair amount of slack in many Asian economies, which is why core inflation in Asia has been so soft. It's the one region of the world, unlike LATAM, unlike EMEA, that you actually had very soft core inflation. And if you look at real rates in Asia, so policy rates in Asia deflated by core, these are very elevated. In other words, many of these countries should have been easing a year ago, but they could not ease because many of them are small open economies, and what happens in the Fed affects them directly, and their policy rate differentials with the US are at historic lows. So if they had cut interest rates unilaterally or preemptively, there would have been more pressure on their currencies and more financial stability considerations. Now, with the Fed cutting, it opens a green light to these economies. We saw Philippines cut in August. We saw Indonesia cut last week. So you'll get a slew of rate cuts in Asia, I think, Philippines, Indonesia, Korea, Thailand in the fourth quarter. India is in a slightly different camp because India, has this war chest of reserves. So the Fed's actions didn't really affect India as much as it did many other economies in the world. And the simplest way to appreciate that is to understand that India's interest rate differential with the US used to be 5 percentage points. It's come down to 1.5 percentage points. So the Fed kept hiking, and India did not have to hike because we've got this huge war chest of reserves. So while the Fed's actions make it easier for the RBI to move, I think primarily this is going to be domestic growth inflation dynamics that drive the RBI.
So what's your sense on that then?
My sense is that with every passing week, the news on inflation is getting better. Remember, core inflation, like in many parts of Asia, has been very soft in India for the last 9 months. The issue was always food inflation. That's 46% of the basket, averaged 8% for the last year. So the RBI correctly wanted to ensure that food inflation gaps down sustainably because it's food that drives inflation expectations. Now, the good news is very strong monsoon, good sowing, global food prices are benign. There's more evidence that food is gapping down. We're seeing inflation undershoot the RBI's own forecasts. So I think we're getting closer to an easing cycle. Now, whether it's October, whether it's December, will come down to the RBI's need to assess whether they need to see more data, right? Because as the governor rightly says, this is not about any 1 month being 4%. This is about having conviction that the next 9 months are in the low 4s. And I think maybe the RBI will require a little bit more time to be certain of that, right? So, but the one point that I think not just the RBI, but many central banks in the region have to worry about is in this world where you have a potential soft landing, right? Risk assets are going to be on fire, right? And you want to be careful as a central bank not to stoke more financial exuberance. So the Bank of Korea is in the same dilemma, that you may have to ease interest rates because inflation is settling towards target. But at the same time, you want to be very vigilant that there's not excessive financial exuberance, and therefore macroprudential measures may well need to be used in tandem to tame those pressures. And I think that's the balancing act that many EM central banks will have to contend with in a world in which the Fed is cutting because the US is heading towards some kind of soft landing. Again, that's not an assured outcome, but that's at this point what many people's baseline is.
Most probably. Yours too, I presume. Most probably.
JP Morgan's baseline, yes.
Okay. From an India perspective, though, some people attribute the lack of pickup in private capex also to the fact that interest rates are stubbornly high. The RBI has an unenviable job then. If it doesn't cut rates, presuming that that's the reason or one of the reasons, then the private capex cycle, which has been waiting, and the government capex might be peaking as well, you would have an insight there too. What happens to the private capex cycle therefore? So
I'm not convinced that the private capex cycle has not picked up because interest rates are high. Because if that was the case, you would have seen booming private capex 2 years ago when interest rates were very, very benign in the pandemic, right?
No, I mean a combination of
and I think it's a good point. I think the distinction is, even though interest rates may be where they are, if you look at financial conditions more generally in India, same issue with the US, they're very benign. Look at asset prices, look at where equity markets are, look at where credit spreads are, look at where liquidity is. Financial conditions actually are very benign. My sense, I think, on the private capex cycle is something that most emerging markets are contending with, which is the elephant in the room here is massive Chinese excess capacity. Right. Now, when you've got so much excess capacity that's flooding into different markets as far apart as Brazil and India, corporates are going to be a little bit more wary of saying we should only invest when we have clear demand visibility given this excess Chinese capacity. So I think we're right in the sense that we need, and I think this process has begun but needs to culminate, is there needs to be more demand visibility for Indian corporates. And when they see that, then there's more of an incentive to invest given that you're competing with a lot of Chinese excess capacity. There's one statistic I'll just throw out on China. China is on course to producing 70 million electric vehicles in 2030 by itself. 70 million. Global demand for EVs in 2030 is expected to be 44 million. China is on course to producing 150% of what the world is going to demand in terms of EVs. That's the quantum of the China shock 2.0 that the world is up against, right? So we need to be realistic in that environment.
Wow. Sajjid, I have a question on the rupee too, but before that, I'm just throwing this out at you. China is producing mammoth sums of all commodities and goods. Right. It is not consuming as much. Exactly. world is not necessarily a growth place currently. Europe, rest of Asia, etc. Maybe Japan leave out. What happens to asset prices in such a scenario, or goods prices in such a scenario?
Right.
Do we see a massive deflationary factor?
Absolutely.
And therefore, is the private capex cycle going to be a lot back-ended than what people believe?
I think it's clearly a pressure point. You're exactly right that we haven't seen the Chinese rebalancing that people had hoped for. There's a huge focus on production. Chinese domestic demand remains very soft. So far, China has been benefiting from strong external demand. But if the global economy is gradually slowing, you can't even be sure of that external demand, right? So where is this capacity going to go? And this is where you get things like trade wars starting, right? The US may well, if there's a Trump presidency, may well impose higher tariffs. Then that capacity may well come to Asia, right? So every country is going to be kind of vulnerable to this excess capacity, and that will clearly have a bearing on investment cycles all around the world.
So India too, there is a likelihood that the private capex cycle might be back-ended for the right reasons, of course.
Yeah.
Because the corporate, as you said, would be very...
I think it comes down to demand visibility, right? I think what Indian corporates will need to see is, if you do see more visibility on consumption, if we do get a couple of more years of public investment by the government, if you do see some strands of export growth picking up, then there's an incentive to do so. But we do need to see that demand visibility for corporates to invest, in a significant manner.
Got it. What's your sense on demand and visibility thereof the next 15 months?
So I think the good news is that we're finally, after a long time, seeing rural consumption pick up. But we need to just ensure that that sustains and that continues. We also have to be mindful that urban consumption, which has been driving it, doesn't slow in tandem. So what you want to be sure of is this is a consumption acceleration and not a consumption rotation. That urban was driving it, rural was soft, now rural is picking up and urban is slowing. So we'll have to wait and see how that plays out. I think the other important point is public investment. And again, the government capex, central government capex has doubled in the last 5 years. And it's important that that goes on for another couple of years at least, while the private sector steps in. And the way to square that is, if we want public investment to not come off sharply, but deficits have to come down for debt reasons, then the focus has to be tax to GDP. So I think India, in the next couple of years, will have to continue down a path where we mobilize revenues, and this becomes a revenue-based consolidation so that we protect public investment. Again, there the initial signs are very encouraging. Last year, gross tax to GDP was 18% for the first time ever, the highest ever. So we have seen some progress on that front. We need to see more progress on that front so we can bring deficits down, but still keep public investment high to provide that visibility to the private sector.
Got it. Wow. Interesting point. My final point, and I mean, I'm just out of the blue just asking you about the rupee. I'm just trying to think. It's a global easing cycle, if you will, say or maybe an idiosyncratic easing cycle, but largely easing.
Yes.
What happens to the rupee, you think?
I think not very much. And I'm saying that because I think the policy actually is the right one. So the way to think of the rupee is to look at the broad trade-weighted real effective exchange rate. That is the broadest measure of competitiveness. And I keep saying that we want exports to grow. We don't want to be flooded by Chinese imports. The last thing in the world you want is a stronger currency. Because if you have a stronger currency, A, your exports become less competitive, and B, your imports, especially in China, become cheaper. Right? So a strong currency is not in the interest of India's growth. And I think the RBI has correctly been ensuring that the broad trade-weighted exchange rate has been flat or very stable in the last 5-6 years. People keep asking, well, why are they accumulating so many reserves? Because if you're focusing on, you can either control price or quantity. You can't do both. The RBI has correctly focused on price, which is the real effective exchange rate, which means quantity becomes endogenous. I have to buy or sell as many dollars as I do to ensure that. So I think that's the right focus, A. B, the reason that India could deviate from the Fed and that interest rate differential has come down is precisely because we had this war chest of reserves. The fact that we have $700 billion, the fact that the current account is very benign, the BOP is in surplus, gives the RBI those degrees of freedom to not have to follow the Fed and to bring those differentials down. So I think we must appreciate, what those reserves have bought for us. And the final thing I'll say is, unlike many countries in Asia, our reserves are not earned reserves. In those cases, they were current account surpluses, countries, and they earn that reserves. Our reserves are borrowed reserves in the sense that they are built through capital inflows. So for every dollar the RBI is holding, there's a dollar in the economy, a liability in the economy which can unwind. So I think the RBI's policy has been very appropriate on the external front, and I think we should continue on that in that vein.
And therefore the rupee kind of stays stable, if you will.
Stays stable. I mean, if we get a chance for it to weaken, we should welcome that, because again, that improves India's external competitiveness.
Great. Sajjid Chinoy, always a nugget or two that comes out at the very least. Today was no different. Thank you for your time, and have a great conference.
Always a pleasure. Thanks very much.
Well, the pleasure was ours, and viewers, thanks for tuning in.